Markets with Kevin Muir, author of the Macro Tourist newsletter. Hi, Kevin. It's great to
Uh,
have you on the show.
Thanks for having me on, Maggie. I've been looking forward to this for a couple of weeks now.
Yeah, great stuff. So, and as we were just mentioning, an awful lot to talk about. So we had a little bit of a pullback in U.S. stocks today, but gosh, it's been a record run, like 6 weeks in a row up. But we did have so natural to see, I guess, a pause or a pullback. But we did have Treasury yields, gold, and the U.S. dollar all higher. So as you look across, and we're in the thick of earnings season, as you sort of look across these markets, what's top of mind for you? What are you really focused on?
Well, one of the things that you can't help but kind of put to the forefront now is the election. And really, when I'm thinking about this, I for a while there, it was like we had the attempted assassination attempt, and at that point, everyone was like, Trump's going to win, and then all of a sudden, Biden's out, and next thing you know, it's Kamala's going to win, and it's back and forth. And one of the things that I think has happened in the last couple of weeks is that kind of quietly behind the scenes, there's been a lot of polling and a lot of kind of people crunching the numbers, and there was been a change in attitude. And one of the things, Maggie, is that I like to talk to a lot of kind of different traders on Wall Street and around the world. And I noticed this, as I kind of was chatting with them, that they increasingly thought that Trump was going to do better than everyone expected. Now, all of a sudden, we're seeing that come out in the polls, the public polls. It was originally, it started in just the private polls, and we're seeing that in the public polls. And one of the things that I always kind of tell people is that by the time it's public and we're talking about it and we're talking about Trump's increased chances of win, it's in the market.
Mm.
Like we're getting a situation where we've rallied because big market participants are increasing their chances of Trump winning, and therefore the price of stocks has rallied. And I always just kind of think it's funny that people think, okay, now that it's announced that he's got an increased chance of winning, I'm going to buy it. I'm like, no, you really wanted to kind of change the trade the delta. You wanted to trade the increased chances of him winning. And one of the things that I think that also is occurring that's unusual and especially unusual for me, Maggie, because I hate trading politics.
Mm.
I hate geopolitics. I hate anytime someone starts telling me that there's going to be a war in the Middle East and that you should buy oil. And I'm very much in the Marco Papich kind of like you fade almost all sorts of geopolitical and political concerns. But having said that, I look at the current setup and I really think the market is overestimating Trump's chances of winning. And I'm not saying he's not going to win. I don't know who's going to win. I don't know what's going to happen. But I do think it's interesting that we have the poly market, this crypto site that everyone bets on. Some big whale walks in there and moves the market of this, and then everyone's like, "Oh no, it's a for sure thing that he's going to win." And when I chat in my trading groups with all these different kind of sophisticated players, if I suggest that there's a chance that he doesn't win, and then God forbid that we have a blue sweep, I get told that I'm clueless. I don't know what I'm talking about. There's not a chance that's going to happen. And when I hear that, all I can think to myself is that insurance is going to be underpriced. The reality is that if everyone thinks that's not going to happen, that means now all of a sudden I can play for that without paying too much for something.
Mm.
And so I'm looking at this, and for the first time, I'm looking at dark side bets in terms of the S&P 500. I think that there's kind of an outside chance that there's a blue sweep that it surprises everyone. And I know everyone's going, you're clueless, you don't understand what you're talking about. And Maggie, I'm a Canadian. I'm not trying to say what I want to happen. I'm just looking at the markets, and I'm just saying
Mhm.
that in terms of what the market is priced in, I think that they're overly optimistic of this, and that the reality is that the polls are increasingly um, not very reliable. And I think that's something we should learn. And I was listening to somebody the other day that was saying that if you remember back to 2016, the betting odds, which is in essence what the poly market is, it had a 13% chance of Trump winning. So there was a chance that that was mispriced. Why are we so sure it's not mispriced this time? So for the first time, I'm looking at dark side puts for the November 8th kind of expiry in the S&P 500.
That's so interesting, Kevin, and you bring up so many interesting things, including the polling, right? So we know that it's been kind of wrong in many different ways recently. So it's not just about the presidential election, but we also have. I've been thinking about the fact that we have more and more younger voters who are rolling up to the polls, right? Their numbers are growing. I have no idea if they're
Yeah, and I don't
answering polls. Like, I'm guessing based on my kid's response to me that, like, it's like, "Hello?" They're not I mean, they're not watching television, they're not any of those old now maybe somebody's hacked it, maybe someone we'll find out
yeah.
afterwards, but you're right, the idea that we have our finger on the pulse of what, newly minted voters are gonna do, it just seems incredulous to me. So that's so interesting that you think that. Why do you think everyone's so convinced? Is it just trying to project because they think it would be more positive? Are they paying attention to old data? Why do you think so many people are on the one side of this?
Well, I think that there is a projection, like, on the whole, like, I would say that Wall Street leans more to the right and that they want him to win. So the reality is that they're very quick to say that. Um, I I think I'm not actually I don't have a real
It's like
answer apart
confirmation
from
bias. Like, I want
right.
that to happen. So, well, let me ask a different question.
Yeah, sure.
Why? I mean, do we know that it would be as positive? Because it's kind of like the old ideas of what was right, what was conservative, what was like, there's
Yeah.
tariff. It's very mixed up this time, it seems to me. Are we just betting on that sort of day of knee-jerk reaction first?
Well, I'm not going past that because I do think that ultimately, that the right and those people that are excited about Trump winning might be kind of be careful what you wish for. You might just get it good and hard. And I think that there is actually more long term risk to a Trump presidency than people think in terms of the tariffs and those possibilities. You see guys a lot smarter than me, like Stanley Druckenmiller, talking about these risks and all sorts of folks. But I don't even care about that. I know right now the market is actually pretty convinced that a red sweep would be good for the market, and I think that that's increasingly priced into the market. That is part of the reason that we've rallied.
Mm,
And then you're talking about the polls, and one of the other things that I think is interesting, Maggie, to highlight is that over the last few years, we've seen this incredible kind of divergence between soft and hard economic data,
mhm,
and it has to do with I think it's the same problem. It's
mhm.
this issue about people responses, and it's not that kind of difference between what they people say they're going to do and what they actually do and what they feel is a lot different. And so one of the things that I think you have to be very, very careful about is trading too much on that sort of data, and I think that it's gotten a lot of people in trouble.
Yeah, yeah, that's a great point because there's been frustration. I mean, we were talking about polling, but it's sort of the same idea that
For
sort of
sure.
the data indicators haven't quite worked in the way that they used to. So you're taking out some insurance on that.
Yeah.
Um, and we're talking a little bit about stocks. Let's stay with stocks for a moment. How are you thinking? So the rally, partly Trump. I always worry about, buy the rumor, sell the fact as well. But so
Exactly.
part of it's been Trump.
Yeah.
What else seems to be driving this? I mean, we've had a lot of conversations. We're going into earnings. It felt like a couple weeks ago people were concerned about valuations, and now we're at record highs again. Has that concern gone away? Are valuations seeming more tolerable? How are you thinking about that?
Well, so if we just kind of rewind like a year ago, if you remember back then, we had kind of the most anticipated recession ever forecast. I think that there's one of the Fed districts actually compiles that data, and it goes back to like 1960 or something, and we had never seen so many professional forecasters anticipate or forecast a recession 1 year out. And so the overwhelming kind of consensus view was that we were going to have a recession, and in doing so what they ended up doing is that a lot of investors ended up hiding in the mag 7. It was one of the few places you could find growth, and so it just kind of became this self-fulfilling prophecy. It was a positive feedback loop. And then on top of it, there was some great earnings out of those companies. They were terrific. And so they were hiding in there. And then the rest of the market seemed really cheap. And nobody ever thought that the rest of the market would go up. And I remember talking to people who told me, they said, oh, no, Mag 7's going to go up, but the rest of the market's never going to, broaden. We're never going to get a rally and all the other stuff. And then I look at what's happened over the last 6 months, and it's definitely broadened. And this, especially in the
Mhm.
last 3 months, that we have a situation where all of a sudden, all sorts of other sectors and parts of the markets are doing much, much better, way better than most people anticipate. Like Maggie, I was like having a look at it, and one of the stocks that, well, one of the sectors that I like is actually gold. And gold's obviously done well, and it's its own like different kind of asset. But one of the things that I thought was interesting was that the GDX, which is kind of the gold miners index, it's up year to date 39%.
Pretty
The
good gain.
Nasdaq is up 21%. The Mag 7 is up 44%. Basically, you were almost as good in the GDX as you were in the Mag 7. And there's a whole host of kind of other areas like that, like XLU, which is who would have thought that the utilities would have gone, and or we go and look at the industrials. There's all sorts of things that are doing well. And in essence, what I think has occurred is that we've had this situation where the market has finally had to accept that the economy isn't as bad as everyone thinks, and that they've finally kind of thrown in the towel and they said, okay, I'm going to go out and I'm going to buy the rest of the market. And so they're doing better. And I think that's what's happened. And now the real question is, how much is priced in? Are we at a situation where it's fully baked and you're kind of should be looking at different things? I'm increasingly in that camp that it's getting scarier and scarier in terms of how expensive the market is getting.
Mm.
But having said that, you look at seasonality for the last 2 months, there's no doubt it's positive. And if we get through this election, then I could see a situation where we rally into the year end.
I think that's what a lot of people are struggling with because they feel nervous and yet they feel like they're kind of, going to miss out on what could be another good looking leg to this rally. So certainly if you're retail, you don't want to miss it. But really, if you're a manager, a fund manager, and you're going on quarterly performance, you don't want to be sitting out and missing this, especially because some people missed out on earlier legs of it. So it's a bit of a quandary um,
Yeah. And I
about
think that
what.
they're all stuffed with too much Mag 7 and not enough other things that are doing well. So if anything, if you look at the seasonals, the NASDAQ seasonal going into year end isn't that great, but the small caps are. I could see a situation where small caps rip, versus the Mag 7 or versus the NASDAQ, going into year end. And I know all the reasons why small caps stink. Like you don't need to tell me them. We all do because everyone keeps, pounding that thing, but it's a question is how much bad news is priced in there.
Yeah. So a rotation. I mean, if we see
Correct.
a sort of, a Santa Claus rally, maybe it's more of a Santa Claus rotation. Do In terms of the Nasdaq, and this touches on what you just mentioned, even though from a rational point of view, I think everybody thinks this thing has overrun and everyone's concerned about an AI bubble. But gosh, Nvidia and those stocks just keep going up and you've missed out on some pretty sizable gains if you weren't in them.
Do you do you
How do you
do you,
figure out what to do going forward? I mean, we
do
had Druckenmiller say he's kicking himself and sick about it.
that's the Druck. He's such a goat that's basically a big that he considers it one of his big mistakes of his life that he sold Nvidia too early. It was
Too
only a
early,
triple. It was
right?
only a
After he made a
triple instead of
bajillion dollars
yeah,
off it.
exactly. Um, I'm not sure I would agree with your premise of your statement, though, that everyone is kind of sitting around and not fully invested in those things, because I really do think that the attitude and the positioning for the Mag 7 is completely different now. And all I have to do is look at the fact that today we had Carson Block, notable short seller, come out. And what did he say? He said, like, I would have been better off just owning the Mag 7. To
Yeah.
me, these are the sorts of things you hear closer to the top
Yep.
than you know halfway through.
Oh,
And I
I
know you,
think everyone's in it, Kevin. I'm
yeah.
wondering though, I think they're in it and they want to get out. But the problem is trying to figure that
I
out.
don't even know if they're trying to get out, because I think that if anything, the way I see it, I think that they're all long Mag 7. And if anything, the real pain trade is if the other stuff goes up. And I think that's actually what hurts them more than the Mag 7 going up. And you're correct. Nvidia today is hitting a new high and stuff like that. There is still a chase going on in certain aspects of it, but the Mag 7 is no longer the sole lead part of leadership of this market. And there's plenty of other parts of it. And I think that the surprise will be, and it'll be interesting to see this earnings season, because there's a lot of optimism priced into those Mag 7 names, whereas a lot of the other, companies, there's not so much optimism priced in. So if we see an actual broadening, not only on the stock market, but on the earnings, meaning that the beats end up coming from other names, then
Mm.
you'll see kind of a chase from the pod shops and the quants and things of that nature. Because we have to, don't forget, we need the Mag 7 and the Nvidia to keep beating and keep growing. And if all of a sudden those earnings estimates start getting revised lower, there's going to all of a sudden that will be quickly for sale, and the
Yeah.
attitude will change.
Great point. We had a really hi everyone in the chat. Um, Great to see you. And we have a really interesting question while we're talking about sort of Mag 7 and then the hot stocks from Melson. Do you have any thoughts on long Elon Tesla as an expression of Trump winning? Macro trades have increasingly priced in that outcome, the outcome of Trump winning, but
So
Tesla as a election trade?
I think that's a great question. I do think that people are doing it. And one of the things that if you go look at like the Goldman Sachs basket or Morgan Stanley, they all have it of kind of trades that'll do better under Trump versus under the Democrats. You'll see that those things have already run and they're already going. I personally think that Elon's a troubled character, and I don't have want nothing to do with his stock. And if anything, I still think that over the long run, the car industry is a terrible industry that is headed a lot lower. And I wouldn't be trying to trade Trump winning by buying Tesla. That there's better ways to express that trade.
Mm. Uh, so let's talk a little bit about if that's your view on stocks. Let's talk a little bit about bonds
Okay.
and the relation between the two, right? As
Yeah.
that's been the other thing people are struggling with, especially as they're we're going to go into year end and turn the corner, and lots of folks are always trying to figure out what should my asset allocation look like, and how do I protect myself, and if things get dicey, is that a haven or is that not? What's the bond market telling us? A lot of threads there. So what's your general outlook on bonds first? Let's start there.
So I have been a bond bear for a long, long time. Uh, Basically, I think it was always funny when people told me that we couldn't make inflation, which you don't have to go back that far to remember points of, hedge funds telling me, "Oh no, we can't make inflation. We have the 3Ds: demographics, debt, and disinflation from technology, and there's no way we can make inflation." And I've always said, with the political will, you can always make inflation, and I think that COVID has proven that, and we're there. So now the real question ends up being, are we going to go back to the post GFC, pre COVID world of low interest rates, and was that the normal kind of environment? And for the bond bulls, I think that they're really holding their hat on that. Like they're really trying to imagine that we're going back to that point. You take the Rosenbergs of the world, he thinks that we're going to get a collapse, an economic collapse, and then next thing you know, we'll be struggling to make 2% growth. It, Rates will be zero and the 10-year will be 2%. And I understand that. And great trader never says never. So I'm not going to say that can't happen, but I'm just asking, like, how likely is that? And I think one of the problems is that we've gone through this 40-year bull market in bonds from 1982 and the point that Volcker broke the back of inflation all the way to 2022. We had this situation where bond yields just kept going lower and lower and lower. And this is kind of what everyone is being conditioned to expect. And I think one of the problems is that when we have this bear market in bonds, they've all forgotten how to trade it, and they've kind of not don't realize that we could have kind of, if inflation continues to be a problem, then bonds could continue to be in a bear market and not do anywhere near as well as everyone thinks they're going to do. So we can talk about the Stanley Druckenmiller concerns about, the deficits, or people arguing that we're going to lose our reserve status and all that
Mhm.
sort of stuff. And those are all kind of good bond bear arguments. I don't even think you need to make those arguments to still say bonds are not a good investment. And let me tell you why. If we go and we have a situation where the Fed lowers rates, and let's imagine that the Fed lowers rates to, 200 basis points down from here. So we go from 5.25 or wherever we are down to 3.25. And that's approximately where the market right now is pricing in the trough rate, meaning the bottom of the Fed cutting cycles. So if we go to 3.25, okay, and then that actually causes the economy to pick up. They lower rates, the economy picks up. Generally what happens, or what has happened over the last 70 years, is that the yield curve steepens. And I went and recently did a study, and I chose the point of maximum inversion on the 3-month versus the 10-year bond. And then I looked at the point of maximum inversion to the point of maximum wides. Okay. So we go, and then on average, it moves about 400 basis points. So we were minus 200 basis points at the maximum inversion. By the way, that was the most it's ever been. And if we put 400 on that, we're going to go to 200 plus 200 basis points. So if we assume that the Fed cuts down to 3.25, and then the economy gets going, and then the yield curve steepens, that means that the 10-year is going to be 5.25.
Mm.
Currently, it's at 420. And so I think that a lot of people are just kind of like, they're assuming that because the Fed cuts rates, that all of a sudden bonds are going to go up in price. And the reason that they're assuming that is because we've been in a 40-year bull market in bonds. And in essence, we had lower and lower rates. We had lower lows when the Fed cut, and we had lower highs when the rates went back up. I contend that we're in the opposite situation now, where we're going to, the Fed will need to cut less, and all of a sudden inflation will come back and it'll get going. And next thing you know, that we'll have higher rates in the future. And I thought it was interesting the other day. I was listening to Druckenmiller, who is just my hero, and he says that when the Fed cut rates 50 basis points, I sold the long end hard that day.
Mm.
And the reason he sold the long end was because he realized that the Federal Reserve was more willing to tolerate inflation. And that means a steeper yield curve. So it ends up being really, what is your belief about the trough rate? Like, how low before the economy gets going? How low before inflation takes off? And I happen to think it wouldn't take very much before of the Fed cutting, before the economy gets going again. And we're going to be surprised at the kind of the resiliency of both the economic strength and also, even more importantly, inflation. And I think ultimately that is what the bond bears are missing. And I'm not trying to say that we're not going to get into a situation where the Fed doesn't cut rates, because I do believe they're going to cut rates and that they're going to want to do that. They're going to want to stimulate. I'm just arguing that that's not the buying bonds or buying the long end is not the best way to do it. And in fact, I think it's going to be the opposite. I think you could get a situation where the front end goes down in yield and the long end actually goes up in yield, which would kind of blow a lot of the bond bulls' minds.
Yeah. Um, by the way, you mentioned David Rosenberg, Rosie. I think I mentioned to all of you, I spoke to him last week. I had a long conversation with him last week, and he's I don't know if it would be fair to say completely changed his mind, but he is very contemplative right now and watching things really closely, and is not the convicted bond bull he was, and maybe completely changing his call, and really walks through where he thinks he got things wrong, what's making him nervous now. So he's really, really in a watch and see. It was very interesting conversation with him. That'll drop this week, folks, maybe tomorrow. So yeah, he's kind of tamed, I'd say, Kevin.
Okay. Well, I shouldn't have invoked him, maybe. The other
No,
bond
no,
bulls.
but
Oh,
but you're absolutely right, because he was one of the loudest voices on
right.
that. But I think he is also looking at some of what you're looking at. He's also looking closely at the election, and that's really, I think, going to be
Yeah, I
the
think a lot of
catalyst.
people are getting scared about Trump winning a red sweep, meaning a lot of spending.
Yeah,
And I contend that even, put those things aside, because I'll agree that if he goes and does a bunch of tariffs and we get into a situation where there's inflation, bond market's going to get into trouble. But I don't even think you need to have some sort of extreme outcome for bonds to be a crappy investment.
right.
I think they could just be a crappy investment on their own.
Do you think, though, that the fiscal situation we've already seen is responsible for that? I mean, we might get more. No one's talking about cutting rates, but is the reason we are in this higher inflationary period, the economy running hotter, is that because of all the fiscal stimulus we've seen?
100%. We've spent 40 years trying to fix everything with monetary stimulus. It didn't work. And if you think about it, the GFC, we were sitting there, we were trying extraordinary monetary stimulus, and it was just pushing on a string. It didn't do anything. It's part of the reason that China is struggling right now. China is in a classic balance sheet recession, and they're trying to fix it with monetary stimulus. You can't fix it with monetary stimulus. If there's no one willing to borrow, then lowering rates does not change anything. So, we saw this in Europe as well. Europe went and put rates negative. I contend that actually negative rates were counter, expansionary, and they actually encourage people to save even more. Like if you're think about it, you're an Italian grandmother trying to save to send your grandchild to university and they lower rates on you. What does it make you do? Does it make you go out and like spend more? No, it makes you actually save more because your money is actually getting whittled down. So, we can argue about whether fiscal is right or wrong, and there's all sorts of debate about that. I don't think that that's, something we as traders should care about. More fiscal means that there's going to be more inflation and the economy is going to be stronger. So we can debate whether we should do it or not, or we can just go out and position our portfolios accordingly.
Mm.
And Maggie, I just wanted to highlight one of the things that I've been talking about is inflation break evens. And if you go look at actually, if I pulled up here from the moment of the COVID crisis low, March 23, 2020, I put in the Bloomberg Treasury Index. It's lost 8.5%, 8.84%, almost 9%. In the same trade, if you sorry, in the same period, the Barclays Inflation Break Even Index is up 42%. One of the things people go, well, what is a break even? A break even is long the tip, short the stock, I mean short the bond, so that you're left with just the inflation portion of it. And one of the things that I think a lot of the investors are going to struggle with in the coming years and decades, as we have a kind of a secular increase in inflation, is they're going to look for something to replace the bonds in their portfolio, because I really think the bonds are going to be a terrible investment for your portfolio. And what you need is something that is going to be negatively correlated to the stock market, because when the stock market starts going down, you need something that's going, doing better. And if you think about the different assets, why did the stock market go down in 2022? It went down in 2022 because the Fed was being exceptionally aggressive because of inflation.
Mm.
So in essence, you almost need a pro-inflation trade to complement your stocks as opposed to a deflationary trade. And I'll just
And
leave you with one last thing. When everyone tells me, oh no, we're going to go back to the period of deflation and disinflation, I go, how many countries do you know that have kind of collapsed because of deflation? Like I know none. Okay. I know all sorts of countries that have run into trouble taming inflation. So yes, there will be ebbs and flows where all of a sudden we get a situation where some people get in and they try to balance the budget and they say that this will be better. But what'll happen is inevitably we'll get into a situation where the economy starts to do badly and they'll spend again.
mm.
They've opened the Pandora's box in terms of fiscal spending. People realize how easy it is to fix economic problems. And in the coming years and decades, the problem won't be one of deflation, it will be one of inflation.
By the way, we just put a poll up in the chat, and 81% of the people listening agree with you, Kevin, that inflation. So you're speaking to your people. So bonds um, not a good position in a portfolio in this new inflationary environment as something that's non-correlated to stocks. Is gold the answer?
So gold is one of the answers. I think that gold definitely works. Now, having said that, I think gold has been moving on a completely and utterly different reason. And when I first brought this up, everyone thought that this was insane. And if you think back, Maggie, to a year or two ago, everyone was focused on the US dollar and real rates on gold.
Mm.
And I can't tell you the number of gold bulls, like die in the wool kind of gold bulls that missed this move because they were in essence focused on real rates and the dollar, and they said, no, look at this correlation, this is the jaws of death, like one's going one way, the other one's going the other way, I can't go and I can't buy gold here. And I always said gold is no longer trading as a US dollar proxy or a real rate proxy. It is trading as a central bank kind of a diversifier,
Mm.
and it took a while, but that has finally gotten to the mainstream. I think that kind of view has been accepted. And one of the things I worry about, Maggie, is that I feel much more comfortable when everyone tells me that I'm wrong, I don't get it, and that my ideas are wrong. And when everyone starts agreeing with me, it makes me more nervous because it gets more fully baked in. Bank of America recently came out with a big, buy gold kind of call. I see Josh Brown was on CNBC the other day talking about how he said you can't lose owning gold. Feels a little scary to me. I feel like we've kind of got this point where gold has become this mythical trade. And I think one of the things that everyone should be remember about this is that it is getting driven by central bank demand. It is getting driven by the People's Bank of China. And one of the things that I think is interesting is that people will hear, they'll go, People's Bank of China isn't buying any more gold. So therefore, I shouldn't buy any more gold. I'm like, People's Bank of China is not going to tell you when they're buying gold. They're going to find ways around it and stuff like that. You shouldn't be caring one iota about their headlines. But if you're sitting there and you're the People's Bank of China and you're trying to buy a lot of gold over the long period, and ultimately that is what they are trying to do. They are trying to accumulate a big portion of gold, and it is a small market. The last thing they're going to want is for this market to take off and to get run away from them. So my suspicion is that just when things look the greatest, they're going to walk away. And so I see everyone getting all bulled up about gold. It makes me nervous. It makes me go think that it's probably not time to be chasing gold in the commodity itself. And I'm just going to say a quick aside. I've always said that the gold market will end with $1,000 up week, and that $1,000 up week, Maggie, will probably come when I'm sitting here preaching caution.
Yeah, exactly. Right.
But I
Murphy's
will say
law,
one
right?
last thing. I'll leave you guys with. I think that you should be looking at the miners, the gold miners. In the past, the gold miners have stunk. They've found a way to lose money and stuff like that. Gold has risen at such a fast pace that even the gold miners are going to make money. And I think we're going to have a situation where the earnings are finally going to click in, and you're going to get like the quant shops, the pod shops, and everyone into this trade. And the way they're going to do this is they're going to do it through the miners. So my suspicion is that in the coming weeks, months, quarters, that you might be better off in the miners than the gold itself.
Yeah, great point, Kevin. I just want to follow up on that. By the way, really interesting comment about central banks because Michael Cal said to me some months ago, when we were talking about gold, I understand the attraction. It's just really hard for me because I never know when central banks are going to be buyers or sellers.
Yeah.
And so, and Michael's coming on, by the way, in a couple of weeks. So we'll ask him about that. But really astute point on that. Do you think that China would turn around and sell? You mentioned they don't want the market to get away from them. So do you think that whether it's China or another central bank could sell on the edges or now or for periods so that they don't have it just going one way? Is that what you're implying?
I think them just walking away and not buying would cause, the market to sag. Because I
Oh,
think
right,
that
because you just
I
remove the buyer, right? So they
Yeah,
just have to stop
they've been
buying for a
on the
while.
bid for a long time. And
Yeah.
and this is for what you'll see, you'll get bad news. All the gold guys will say, "This is it. We're finally turning." And then by the end of the day, it's back up. And that's them accumulating gold. And if all of a sudden they just stop doing that, it'll be slightly different. Then what'll happen is you'll get some sort of, let's just say, rates go back up, and then some, hedge funds get nervous because rates are going back up and they start selling gold, and then there's no bids and everyone looks around and goes, wait, and then all of a sudden we're down $100.
Mhm.
And but then just when it looks terrible, just when you think, okay, the bull market is over, that's when you should buy it. So I completely agree with Michael's point that it is a difficult market to trade because it is going to trade based upon uh, a long-term big player that is in no interest, is trying to accumulate and not send it too high, but as will buy the dips but then won't chase. So
Yeah.
that's the thing that might be different. Now, having said that, I think that you could get a situation where if all of a sudden the West gets really excited about gold, it just takes off on its own and it doesn't need China anymore. And that very well could be. There's no doubt about it. And one of the things that I think that is interesting is that silver is acting so well. And to me, silver is the Western buyer because we out here in the West like silver more than the typical Asian buyer that will focus on gold. So when you start to see silver do better, that shows to me that there's actually a bull market on this side of the world.
Now that's really interesting. I was going to ask you about that. And yeah, traditionally we are pretty underweight generally in portfolios. Those metals. General Snoozen, thank you for the compliment about the channel. Tell everybody you know. He wants to know what about Dr. Copper?
Um, Dr. Copper, everyone got all excited. Jeff Curry from the Goldman Sachs got in there. I think he called it the trade of his lifetime. And just like a pro tip, never get on a show and call something the trade of your lifetime because you know it's
Kind of
going to
like
go
Sports
badly.
Illustrated cover, all that kind of stuff.
That's right. And when you see someone calling something the trade of their lifetime, you should be taking the other side of that trade.
Beware.
And I remember that Dennis Gartman, the famed newsletter writer, said that oil would never go below 40 or something in his lifetime. And luckily, he's still with us, because oil definitely went below 40. So back to copper. I think that it's a good bull story. I completely get it. I think that a lot of people still think it's more driven by China than it is. A lot of people say, "Oh, I want to bet on China, therefore I'm going to go bet on copper."
Mm,
I'm not sure that's the best way to do that. You want to bet on China, go bet on China. Copper's got a good long-term, supply demand story. It's easy to get bullish about it. Having said that, I think that there's kind of sexier, better stories out there in terms of, like, I like the white metals a lot better than I like copper. Palladium and platinum. Think they're just more interesting. They're down and out and stuff like that, and you can find something below the marginal cost of production. I think it's an interesting play. But having said that, if someone wanted to own copper, I'd have no problem with it. I'd be like, yeah, I think it's a great long term play.
got a couple of different comments. I'm going to just squeeze a couple of these in because there's such good questions. Um, Are you a few wondering, are you describing a situation when you were talking about inflation before that looks like stagflation? Are you worried about high inflation and low growth, low or no growth, or do you think that we will see both the economy and inflation run hotter?
I think that we will see both run hot. I'm not as concerned about this idea that we're going to get this terrible stagflation. I actually think the economy is pretty strong. I think that a lot of the problems with people on Wall Street that think the economy is doing bad is that they're stuck on the coast and they're not going to middle America and seeing that a lot of the middle America is doing quite well. I was just chatting with a buddy today and he was saying, he's from Wisconsin, and he said something to the effect like, "I talk to people at home, everything's great, like things are going well." And then another guy was saying, "Yeah, I'm in the kind of northwest, and everything's great there too." So I think that a lot of the problems that people perceive are a lot, in terms of growth, are a lot higher on the coast, and that I think that the actual economy is stronger than people think.
Yeah. You really quickly, Canada. We
Okay.
have a couple of Canadians in the chat wondering about how you're feeling about Canada.
So I am a huge Uber bear on Canada, and I'll tell you why. So for every time when people were bearish on the US, I always said, listen, if you're bearish on the US for all these reasons, I got a country for you that's got it way worse, and it's Canada. Let me tell you why Canada is so much an easier short and an easier bear market than the US. One, in terms of the fiscal stimulus, you guys did 24% of GDP. We did 16. So there's just less spending in terms of our economy. So we didn't stimulate as much and we didn't goose our economy like you guys did. And you're still feeling that, by the way. That 24% of GDP is still rifling through the system. It's part of the reason that your growth is so great. So that's the first thing. Second thing, in terms of our debt to GDP on the consumer basis, you had this run up. You were ahead of us going into the GFC. I think you guys got it up to 100 or something like that. We were slightly behind you. GFC happens. We get this big implosion, and your debt to GDP in terms of on a consumer basis goes down to 74%. Well, what do? We just keep going. Like, Canadians are crazy. Our debt to GDP, I can't remember the latest number. It's like 120 or 125. It's way higher than at your worst in terms of the GDP, the GFC, like pre GFC point. And then the third one is, everyone will say, but wait, your growth is actually quite high. Like, why is that? Like, you must be wrong. Like, things can't be that bad. And one of the things that occurred in the post COVID world is that we had an aggressive immigration policy.
Mhm.
And what we let in more people, and our population growth was basically the same as the baby boom in terms of the amount of people we let in. It was like crazy. Like we're 35 million people or something. We were letting in 1 million people a year, some crazy number like that. So when you look at our GDP was third in the out of the G7, I think behind you guys and maybe behind Japan. So we were third, But then when you do the GDP per capita, it was actually we go from the third to seventh. We're the worst country in terms of GDP per capita. So in essence, we have been we've been goosing our numbers by having all sorts of population growth.
Mm.
Okay. Now the thing about that population growth is that that's finally we've hit this point where we've let in so many people. And listen, my mother is an immigrant. I am Canada is a nation of immigrants. So I am pro immigrant, but I don't want to see a situation where we're letting in too many people and we're not being fair to the people that are coming here because there's not the infrastructure to support them, and we're not being fair to the people. So we've had this kind of change in attitude in Canada in terms of like, no, we can't just have fettered growth. We need to do this smartly. So we've pulled back in terms of the immigration. So we have this situation where our housing is the most expensive it's ever been with the most debt, where immigration is pulling back. And not only that, I actually missed the whole part of the housing is that we actually don't have 30-year mortgages like you guys.
Yeah.
You guys all locked in your mortgages. Ours are all going in, and they're going up and down in terms of the rates. In terms of ours, the longest is generally 5 years. So we have this situation where people's mortgages are rolling over and it's killing them. So we have this terrible, terrible setup, and our central bank, I think he's the worst central banker out of all of the central bankers because he was completely clueless about what he was driving us into when he was so aggressive raising rates. He thought he was going to be cool for a little while. He was actually ahead of you guys in terms of being more aggressive and hiking rates. He's like, oh, I'm going to show those Americans I'm going to be faster than they are raising rates. And he's just clueless. Anyways, the long and short of it is we have hit a situation where Canada is finally rolling over. All these things are coming to a head at once. The immigration slowing down, the housing is slowing down. We have a situation where rates are still too high. They're going to be have to let the outlet valve will have to be the currency. There will be no other way around this. We are going to have to go and lower rates big time to
Mm.
solve this problem of this over indebtedness. I see a situation where the Canadian loonie will eventually go to all-time lows. It'll be below 60 cents. That's how bearish I am on it. But Maggie, I'm going to tell you just one last little thing here to leave you guys with. Everyone thinks, oh, that means you should short the Canadian stock market or something like that. I contend do no such thing because a lot of our stock market is resource stocks.
I was going to say,
And
yeah.
if you think about what's going to happen, if we have a situation where the loonie is going, getting offered and is going way back down lower, then all these, gold companies, these energy companies that are selling in US dollars and all their costs are Canadian dollars, these guys are going to print money. And I actually think that one of the greatest trades out there right now is buying Canadian resource stocks. And you have to be very careful here because just being listed in Canada isn't what you really want. You want a Canadian asset. For example, First Quantum is a Canadian company. It's listed on the Toronto Stock Exchange, yet the asset is, in Central America. It doesn't really, it's not going to be
Right. The
affected by
production
Canadian
costs
dollars.
have to be in
Correct. So
domestic.
you go and you look at things like Nico Eagle, or you go pick a CNQ, which is an oil stock, things that are mostly Canada. I think these things are going to print money. So go and you have to hedge the currency because if you're like a non-Canadian buying it, you definitely do not want to be exposed to the currency. But I think they're going to be some of the best performing stocks out there.
Fantastic stuff. This is just Kevin's research, by the way, not financial advice. Only you know
That's
your
correct.
own risk profile, but fascinating perspective. And you can find Kevin's great newsletters on Substack, and we are there as well. Kevin, this has been such a delight. Thank you for giving us so much to think about.
Thanks, Maggie. It was a real pleasure being on with you.
I love it. And you can find all of this stuff in the description, everyone, and get on our email list and you can stay up to date. Thanks. The chat was fantastic. Everyone, thank you so much. Thanks to Kevin. We'll see you all again on Wednesday. Take care and good luck out there, everyone.
Okay.